Hi everyone, I'm Kingsley. Today I'm going to talk about the relationship that exists between shareholders, directors, and auditors of a company. In my previous videos, I explained what is meant by accounting, and there will learn there are two main branches of accounting: financial accounting and management accounting. Financial accounting mainly aims at preparing general purpose financial statements to provide information about a company's financial result, financial position, cash flows, and changes in owner's equity. Today, I'm going to talk about what is the relationship that exists between the shareholder as the main user of financial statement and the directors as the preparers of financial statement and the auditor who investigate and provide an opinion on the financial statements. Well, we'll move to our first slide. So in a corporate setup, in a company, right, the main investor in a company is the shareholders. So shareholders are the people who invest their funds in a company. So accordingly, shareholders are recognized as the owners of a company. In a public company, sometimes you have a lot of shareholders, maybe thousands of shareholders. So when you have thousands of owners, thousands of shareholders, more than thousands of shareholders, how you make decision regarding your company? If it is sole trade business, you have one owner and he's the manager. If it is a partnership, you may have two or three partners, and they are the most of the time they are become the managers of the company. But when it comes to public company, you have a lot of shareholders. So how you make decision regarding the company? Can you all these thousands of shareholders can get together at a particular place and make decision regarding the company's operation? No, it is not practical. So what we practically do is, on behalf of the shareholders, right, we appoint a team of experts to run the company, right? So accordingly, shareholders invest their funds in the company, and those funds and the resources invested by the shareholders are managed, are controlled by directors, and these directors are appointed by the shareholders at the annual general meeting. So directors are appointed by the shareholders, and these directors are the controllers. These directors are the controllers of the financial and other resources of the company. So shareholders invest and directors controls. So accordingly, in a corporate setup, there's a big problem because ownership of the resources are separated from its controllers, right? Shareholders are the owners of the resources and they are controlled by the directors. So according in the corporate setup, we say there's a big issue called separation of ownership from control. So what is the objective of shareholders? Shareholders want to increase their share price. Shareholders want to increase their maximize their profit. But on the other hand, directors, so directors are employed by the shareholders. So directors wants to maximize their package, maximize their financial benefits and other remuneration package. They want to maximize their financial benefits and other benefits, such as company maintain car or apartments. So accordingly, directors wants to maximize their personal gains, financial benefits. So directors benefits is a cost to the firm. So accordingly, how do we ensure directors are working not for their benefits but for the betterments of the shareholders? There we have a lot of mechanism to ensure that directors' interests are not conflicting with that of the shareholders, right? For example, we can pay directors' salary based on their performance. So accordingly, if the directors wants to draw high salary, they want to show high performance. So if they want to make high salary, they need to increase the company's profit or they need to increase the company's share price. So accordingly, we can have some sort of internal different mechanism to ensure that directors are not merely working for the betterments of their personal gains, right? So accordingly, directors are the people who make decisions regarding the resources invested by the shareholders. So accordingly, who are responsible for the company's profit? Is it shareholders? No. Company's profit is the responsibility of the directors because they are the people who make decisions regarding the financial and operating activities of a business. So directors should take the responsibility. If the company's result drops or operating result or profit decrease, then directors are responsible. Now, how do these shareholders, as an external party get to know about the company's result, get to know about the company's profitability and company's financial position. For that purpose, directors should prepare financial statement. So accordingly, it is the director's responsibility to prepare financial statements in line with financial reporting standards or generally accepted accounting principles. Right? So accordingly, directors should prepare the financial statement in line with generally accepted accounting principle or international financial reporting standards. And this financial statement then supposed to be communicated to the external parties, mainly to the shareholders. Now shareholders has a particular doubt, particular problem. What is the problem? Because shareholders know the responsibility for the preparing and presenting financial statement is rests to the directors. At the same time, right, directors are responsible for the profit. Then there's a reasonable doubt these directors can uh, prepare this financial statement in a misleading manner, right? So directors can manipulate these financial statement, right, to mislead the shareholders. So how do shareholders, right, ensure these financial statement prepared by the directors provide true and fair view about the company's financial result and financial position? For that purpose, we have a mechanism. We appoint, shareholders appoint independent external professional accountant as the auditor. So we invite shareholders, give the full permission to attend, to access to the company's resources and all the location, and we give him the permission to investigate financial statement prepared by the directors. So auditor will come and investigate the financial statement prepared by directors, and auditor should do this investigation in line with auditing standards. So that's how auditing standard and accounting standards relate, right? So according to directors use accounting standards and international financial reporting standards to prepare and present financial statements, and auditor will come and investigate whether these financial statements provide true and fair view. Right? How do they ensure whether financial statement prepared by directors provide true and fair view? It's very simple. Auditor just need to ensure whether the financial statement prepared by the directors have been properly prepared and presented in all material respect in line with accounting standards. If auditor satisfied about the financial statements that are prepared by the directors are in line with the have been prepared and presented in line with the international accounting standards, then auditor will express a clean opinion. Auditor might explain these financial statements, which are prepared by the directors, have been prepared and presented in line with accounting standards. So provide true and fair view about the company's financial result and financial position. So the auditors will express accordingly an opinion to the shareholders. Then when shareholders receive the audited financial statement, shareholders will first look at the auditor's opinion, right? So don't ask what if auditors and the directors get together and support frauds and support directors to make frauds. It is possible, but in that we do not, we fundamentally assume, we basically assume auditors will behave in a professional manner. But there are some examples in the world where auditors have supported directors to make some fraudulent financial reporting. For example, Enron case, Volcom case, as the well-known corporate scandals, their auditors have supported directors to make some frauds, right? So accordingly, when you look at the auditor's report, you can see in the auditor's reports, there's a title, audit reports, auditor's report. Then this auditor's report usually addressed to the shareholders and directors of the company, in this case, right, to the shareholders and the board of directors of the Microsoft Corporation. And in this auditor's report, they give an opinion. They give an opinion to the shareholders, so as the users of financial statement, in which they mention that they have audited the financial statements of the Microsoft Corporation, that they recognize the financial statements that they have audited. Then you can see in their opinion what they have said in their opinion, right? In they say in our opinion the financial statements present fairly in all material respects, right? So according they have performed the audit, and in their opinion they express a clean opinion. They say financial statements have been prepared and presented in all material respect uh, uh, in accordance with the applicable financial reporting framework and provide accordingly financial statement provide true and fair view. Well, in the latter part of the same audit report, auditors acknowledge that the financial statements are the direct responsibility of the company's management. So accordingly, directors and the management are responsible for the preparation and fair presentation of financial statements. So directors should prepare their financial statement in line with the applicable financial reporting framework. For many countries, it is International Financial Reporting Standards. For USA, it is GAAP, Generally Accepted Accounting Principles. So directors should prepare financial statement in line with the applicable financial reporting standards and communicate those financial statements to the shareholders. Usually, shareholders are suspicious about the financial statement prepared by the directors because shareholders know directors are the people who are responsible for the company's profit and company's financial position, and directors are the people who report, who prepare this financial statement. In order to avoid this issue, shareholders appoint external independent qualified audit firm or professional accounting firm and invite this professional accounting firm to investigate the financial statement prepared by the directors and express an opinion on this financial statement. Later on, shareholders can read the auditor's audit opinion, audit report, and the financial statement prepared by the directors. Then they can make their own judgment whether to further invest in the company or divest their investment. That's it. I think you guys enjoyed my video. Thank you very much. Bye bye.